Friends, this is People's Advocate Sriman Malla. Today we are going to talk about AFM formulas, advanced financial management problems. We are talking about those. See, under that, I'm talking about valuation. I'm talking about security valuation. I'm talking about security valuation. In security valuation, what we are going to do in security valuation, what we are going to do, you please listen. In security valuation, there will be total earnings. There are two kinds of earnings. One is retained earnings, another one is dividend. The total earning mean earnings available to equity shareholders. How income statement, sales minus variable cost, then you will arrive the contribution, then the contribution minus fixed cost excluding depreciation, you will get EBITDA, earning before interest, tax, depreciation and amortization. Then you can reduce depreciation and amortization, then you will earning before interest and taxes. Thereafter you reduce the interest, then you will get earning before taxes. Then thereafter, I thought put the light. Friends, this is People's Advocate Sriman Narayana Malaya. People's Advocate Sriman Narayana Malala is aim to help the marginalized people nationally, internationally, globally, wherever injustice happened to the common man. The People's Advocate Sriman Narayana Malala will be there to help them, to serve them, to assist them before any court in India or outside India. So here, this advocate came in front of you to media and YouTube channel to educate everyone in the world. The moment you become the educate, you can earn money. The knowledge is the power. Knowledge is the power. So the knowledge will be driven the society, and then your life will be comfort. Today you are going to learn about the money management. How to handle the money, how to earn the money, what the way of earn the money, how the value of the company, how the value of securities. So we are talking about security valuation. So the moment you talk about security valuation, you should understand how those will be work. You need to understand how those will work. Now I am going to talk those. My dear friend, see, there are two kinds of earnings in the market. In the stocks, especially if I invested, for example, in TCS, I hold 10 shares. 10 shares into 3,000 today, 30,000 investment is there in my investments in Tata company. I mean, the Tata consultancy services. Then what I will earn, either retained earnings I will earn or dividend I will earn. In order to compute the income statement, sales minus variable cost is equal contribution, contribution minus fixed cost excluding depreciation is EBITDA, EBITDA earning before interest, tax, depreciation and amortization. Less you reduce depreciation and amortization, then EBIT will come, EBIT minus interest, then EBITDA will come, EBIT minus tax, then EAT will come. This EAT minus preference dividend, then earnings available to equity shareholders will come. Then equity dividend divided by total funds, reserves and surplus, then you will get some basic ratios. What are the ratios? EPS. What is meant by EPS? Earning per share. How will come earning per share? earnings available to equity shareholders divided by total number of equity shares is equal to EPS. What is DPS? Total dividend paid to equity shareholder divided by total number of equity shares is equal to DPS. What is MPS? MPS is equal to market price per share is equal to total market value or market capitalization, market cap divided by total number of equity shares. Then REPS. REPS means what? Retained earning per share. Total retained earnings divided by total number of equity shares is equal to REPS. Then REPS is equal to EPS minus GPS. Then dividend yield. See what is meant by dividend yield? I'll see that, my dear friend. Dividend yield is equal to dividend DIVIDEND. Dividend yield is equal to dividend per share divided by market price per share. See, DPS divided by MPS into 100 is equal to dividend yield. What is meant by dividend yield, my dear friend? Mr. YouTube watch viewer. What is meant by dividend yield? Dividend yield is equal to DPS divided by MPS into 100. Friends, what is meant by dividend payout ratio? This is also important. I'll write, my dear friend. Dividend payout ratio. Dividend payout ratio. Dividend payout ratio is equal to dividend per share divided by earning per share into 100. DPS, dividend per share divided by earning per share EPS into 100. Dividend rate is equal to dividend per share divided by face value per share. Dividend per share divided by face value per share. Face value per share. Dividend rate is equal to dividend per share divided by face value per share. Earning yield, EARNING, earning yield is equal to earning per share divided by market price per share. Earning per share divided by market price per share. Market price per share. PE ratio is equal to earning yield వచ్చేసి earning per share divided by market price per share. PE ratio is equal to MPS divided by EPS. MPS divided by EPS. Retention ratio. Retention P. Friend, dividend payout ratio is equal to dividend per share divided by earning per share into 100. Dividend rate is equal dividend per share divided by face value per share is equal dividend rate. Earning yield is equal to earning per share divided by market price per share into 100. PE ratio is equal to MPS divided by EPS. Retention ratio is equal to retained earning per share divided by earning per share into 100. Retention ratio, RETENTION, retention ratio is equal to retained earning per share divided by retained retained earning per share divided by retained earning per share divided by earning per share earning earning per share earning earning per share into 100 into earning per share into 100. EPS minus DPS divided by EPS into 100. EPS minus DPS divided by EPS into 100. EPS minus DPS divided by EPS into 100. Retention ratio, retention ratio, retention ratio, retention RETENTION, retention ratio is equal to 1 minus dividend payout ratio, 1 minus dividend payout ratio, 1 minus dividend payout ratio, and then the relationship between retention ratio is equal 100 or 1. Dividend retention ratio plus dividend payout ratio is equal 100% or 1. Friend, the dividend yield earning and earning yield is always calculated on annual basis. Dividend first paid to preference shareholder before any declaration of dividend to the equity shareholder. So dividend is always paid upon the face value and the market value. Dear friends, remember. Dividend is always paid on face value. Okay, that's important. Next, the define the cash dividend, stock split. The cash dividend is the name of the implies or payment made to shareholder in cash. They come in three forms: either regular dividend. The regular dividend occurs when company pays out of portion of the profits on a consistent basis. Example, quarterly or yearly. A special dividends, they are used when favorable circumstances allow the firm to make one-time cash payment to shareholders in addition to any regular dividends. Example, cyclical funds. Cyclical funds. Liquidating dividend occurs when company goes out of business and distributes the proceeds to shareholder. See, liquidating dividend occur when company goes out of business and distributes to the proceeds to shareholders. Stock dividend bonus shares. Stock dividend are dividends paid out in new shares of stock rather than cash. In this case, there will be more shares outstanding, but each one will be worthless. Stock dividend are commonly expressed as a percentage. A 20% stock dividend means every shareholder gets 20% more stock. Stock split. Stock splits divide each existing share into multiple shares, thus creating more shares. There are now more shares, but the price of each share will be drop correspondingly to the number of shares created, so there is no change in the owner's wealth. Splits are expressed as a ratio in 3 for 1 stock split. Each old share is split into the 3 new shares. Stock splits are more common today than stock dividends. Stock dividends bonus shares. Stock dividend are dividends paid out in new shares of stock. Rather than cash, in this case, there will be more shares outstanding, but each one will be worthless. Stock dividends are commonly expressed as a percentage of 20% stock dividend, means every shareholder get 20% more stock. A stock split. A stock split dividend each existing share into multiple shares, thus creating the more shares. There are now more shares, but the price of each share will drop correspondingly to the number of shares created. So there is no change in as a ratio in 3 for 1 stock split. Each old share is split into 3 new shares. Stock splits are more common today than stock dividends. Effect on financial ratios. Paying a cash dividend decreases assets, cash and shareholder equity, retained earnings. Other thing equal the decrease in cash will decrease a company's liquidity ratios and increases. It's a debt to assets ratio will, while the decrease in shareholder equity will increases his debt to equity ratio. Stock dividends, stock splits, and reverse stock split have no effect on company's leverage ratio or liquidity ratios or company assets or shareholders equity. Return concept. A sound investment decision depends on the correct use and evaluation of the rate of return. Some of the different concepts of return are given as below. Required rate of return. An asset required rate is the minimum return an investor requires given the asset risk. A more risky asset will have a higher required return. Required return is also called the opportunity cost for investing the asset. If expected return is greater, less than the required return, the asset is undervalued or overvalued. Price convergence. If the expected return is not equal to a required return, there can be a return from convergence of price to intrinsic value. Letting V0 denote the true intrinsic value, and given that price does not equal that value, V0 is equal V0 not equal to P0. Then the return from convergence of price to intrinsic value V0 minus P0 divided by P0. The price convergence, the return from the convergence of the price to intrinsic value is P0 minus V0 minus P0 divided by P0. Price convergence. Price convergence. Price convergence. Price convergence. Then the return from convergence of price, the return from convergence of price to intrinsic value, the return, the return, the return from convergence, from convergence, CONVERG of price, the return from convergence of price to intrinsic value, to intrinsic value, to IN TRIN SIC, intrinsic value, is V0 minus P0 divided by P0. If an analyst expects the price of the asset to convergence to intrinsic value by end of the horizon, then V0 minus P0 divided by P0 is also the difference between the expected return on an asset and its required return. Expected return is equal to required return plus V0 minus P0 divided by P0. Expected return is equal to expected return is equal to expected return is equal to required return plus V0 minus P0 divided by P0. Suppose the current price of the share ABC Limited is 30 rupees per share. The investor estimated the intrinsic value of ABC Limited share to be 35 rupees per share. With the required return of 8% per annum, estimate the expected return on ABC Limited. Intel's expected convergence return 35 minus 30 divided by 30 into 100, that is equal to 16.67%. And let's suppose that the convergence happens over 1 year, thus adding this return with the 8% required return, we obtain an expected return 24.67%. Discount rate is the rate at which present value of future cash flows is determined. Discount rate depends on the risk-free rate and risk premium of an investment. Internal rate of return is defined as the discount rate which equates the present value of the future cash flow to its market price. The IPR is viewed as the convergence viewed as the The IPR is viewed as the average annual rate of return that investors earn over their investment time period, assuming that cash flows are reinvested into the IRR. See, the discount rate is the rate at which present value of the future cash flow is determined. Discount rate depends on the risk-free rate and risk premium of an investment. Internal rate of return is defined as the discount rate which equates the present value of the future cash flow to its market price. The IRR, internal rate of return, is viewed as the average annual rate of return that investors earn over their investment time period, assuming that cash flows are reinvested at the IRR. Example, dividend price of share. If question is silent, always assume ex-dividend price of share. If cumulative dividend price is given, we must deduct dividend from it. It may be noted that in all the formula, we can consider ex-dividend not a cum dividend. Okay. Now, friend, the valuation model based on the earnings and dividend. There will be Walter model. The Walter supports the view that the dividend policy plays an important role determining the market price of the share. He emphasizes two factors which influence the market price of share: dividend payout ratio, the relationship between internal return or on retained earnings or and cost of equity capital KE. Walter classified all the firms into three categories: growth firm or greater than KE. In this case, the shareholders would like the company to retention maximum amount to keep payout ratio quite low. In this case, there is a negative correlation between dividend and market price of share. If R greater than KE, lower than the dividend payout ratio, higher than the market price per share, vice versa. Declining the firm or less than KE, in this case, the shareholders won't like the firm to retain the profit so that they can get higher return by investing the dividend received by them. In this case, there is a positive correlation between dividend and market price of share. If R less than KE, higher the dividend payout ratio, higher the market price per share, vice versa. Constant firm. If rate of return, if rate of return on retained earnings R is equal to the cost of equity capital KE, in this case, the shareholder would be indifferent about splitting of the earnings between dividend and retained earnings. If R is equal to KE, any retention ratio or any dividend payout ratio will not affect market price of the share. Market price share will remain the same under any dividend payout or retention ratio. Walter concludes the optimum payout ratio is a nil in case of the growth firm. The optimum payout ratio for declaring the firm is 100%. The payout ratio is a constant, firm is irrelevant. See, the summary of the optimum dividend as per the Walter model, if return more than cost of equity, then correlation between DPS and MPS is negative. The optimum payout ratio is 0%. Optimum retention ratio 100%. constant. For example, R is equal to KE, no correlation, every payout is optimum, every retention is optimum. Decline R less than KE, the correlation between DPS and MPS is positive. Optimum payout ratio 100 percentage. Optimum retention ratio is 0 percentage. Valuation of equity, valuation of equity as per Walter, the current market price of share is the present value of two cash flow streams. Present value of all dividend, present value of all return on retained earnings. In order to testify the above, Walter has suggested a mathematical valuation model. So the P0 is equal DPS divided by KE plus R divided by KE, EPS minus DPS divided by KE. See, the valuation of equity as per Walter, valuation valuation of valuation of equity as per valuation of equity as per Walters, 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 P0 is equal to DPS divided by KE plus R divided by KE, R divided by KE, EPS minus DPS divided by KE. P0 is equal to DPS divided by KE plus R divided by KE, EPS minus DPS divided by KE. Dividend per share divided by cost of equity plus R by KE into EPS minus DPS divided by KE. P0, what is meant by P0? P0 is the current price of equity. Share X dividend price, fair value or theoretical or intrinsic. P0 could you called as the current price of equity share or X dividend price or fair or theoretical or intrinsic or equilibrium or present value or equilibrium or present value price per share. DPS, dividend per share paid by the firm, R is equal to rate of return on investment of the firm, IRR or return on equity. KE is equal to cost of equity share capital, discount rate, expected rate of return, opportunity. KE is equal to cost of equity share capital, discount rate, expected rate of return or opportunity cost, capitalization rate. The EPS is earning per share. DPS is retained earning per share. So the P0, if I want to compute the P0, DPS divided by cost of equity plus return divided by cost of equity into EPS minus DPS divided by KE. This is the formula, my dear friend. See, assumptions are DPS and EPS are constant. Cost of equity and or constant. Going concern assumption, company has infinite life. No external finance. Gordon model, growth model, dividend discount model. This is another model we'll discuss within the 5 minutes. JM to JA. Hi, sir. As somebody is asking me question through YouTube, can you reach out the people? Can you reach out me? My mobile number is 9677205265. Can you reach out me? Can you reach me by 9677205265? Gee. నమస్తే బ్రో. ఆఫీస్ వాళ్ళు బ్రో. Cash flow statement. No, bro. Tell me again. I don't understand. Cash flow statement, right? Okay. No. What do you want me to take? There's a preferred difference. So okay, send me. I'll try. 2 year balance sheet includes delta. Bro, these are going to take time. No, the train out studies now. Hello, bro. Yeah, this is in, because in other time now okay, because the moment I enter there, I need to check everything. Then only I can come to conclusion also. You take time, bro. I'm studying, bro. If it is a small thing, I can do. But